Alrighty, folks, I have a surprise guest for you. Somebody I first heard about while reading a Real Deal article about all the pain coming to the syndication world. We've got Brian Underhall from Newvo Capital Partners. How you doing, man?
Great, Michael. How are you?
I'm doing well, Brian. Do me a favor, introduce my audience to who you are, what you do today, maybe give you a little bit about your resume, because I think that is important as well, because we have a lot to talk about. There's a lot of pain/opportunity coming to the syndication world.
Sure, Michael. So I work with Newvo Capital Partners. I'm their chief analytics officer. Really dive into the numbers on my end. That's kind of my role. We're a private equity real estate firm. We specialize in multifamily apartment buildings. Prior to this, I came on with Newvo about 3 months ago. We all have plenty of experience in the space, but we came together under a new umbrella for the opportunity that we see coming over the next couple of years. Prior to that, I was with QRE Partners. We were a fund of funds model that essentially took investor capital and then vetted sponsors, syndicators across the country to decide where we were going to allocate that capital. So my role there was really trying to find the best operators across the country to invest with.
So let's start the conversation there, because I think there's where the story is. You know, we're coming to an ending, which I'll reference in the Real Deal article in a minute. But let's talk about the setup, right? How long were you when did you start evaluating operators or syndicators? Was that 5 years ago?
So 5 years ago, our plan was actually to purchase the properties outright.
Okay.
So we started off as syndicators, I guess you could say. COVID came. We kind of put that on pause, and then realized my partners at the time, and they still do, ran a hedge fund out of Tallahassee. So our expertise, our specialty was really on the underwriting process, on the vetting, and we decided to pivot, and instead of operating these properties ourselves, we would focus our energies on finding the best ones and just be more of a portfolio manager than a syndicator ourselves.
Makes perfect sense to me. And the reason I think starting with this story is interesting, because again, I've been in the game 20 some odd years. I believe the syndication model has, raising private capital has been always there for decades, but it got goosed, accelerated, gasoline, whatever you want to call it, put on it. Grant Cardone and so many others kind of selling this model. And my experience, and I'm curious because again, you were evaluating operators across the country. It seemed to go from a very kind of niche, operators to everybody thought they could be a syndicator. So, I mean, what did you see? Experience level come down, deals get worse. What were you seeing over the last 2 or 3 years?
Yeah, exactly what you just described. So when, let's call it 5 years ago, there were a handful that you kind of knew about, syndicators, operators to invest in. I would attribute it to really a handful of things. One, access to information, I guess, is what it really boils down to. A lot of new podcasts, a lot of coaches, gurus, as you referred to them, that were basically teaching anyone with a normal W-2 or just anyone with an entrepreneurial spirit how they can buy these properties on their own. So, not a bad thing. I'm all for entrepreneurship. The issue is that a lot of people that previously had no experience doing this were now operating $5-10 million properties, and some even more than that. And so there's a few other, to take it a step further. Now you have a lot more competition in the space because everyone knows how to do it. And then interest rates come down to zero or near zero. So money is cheap or free. And in order to get a deal done, you had to be the highest offer because there's so much competition. So the prices got bid up, and people were able to take out larger and larger loans. Bridge lenders came into play in the last few years. That really, I think that would be the final thing that poured gasoline on the problem. And so syndicators stepped away from or moved back from agency debt because the agency quotes weren't as attractive as a bridge quote. And the bridge lenders would also press the leverage quite a bit. So instead of getting a 60-70% loan to value Fannie Freddie, you got a bridge lender out there that'll give you 80% and then toss the renovations on top of that. So you're taking out a much higher leverage loan, and what it meant for the operators or syndicators applying for the loan is, look, we need to offer more for this property or we're going to get outbid. We can't go with agency because they won't loan us as much. And if we go with bridge, they're going to loan us a higher loan to value, and we won't have to raise as much equity from our LPs. So it's some combination of all of those things that kind of.
I think there's one more thing that I'm going to say you skipped over, but I think it's important. You didn't do it on purpose, but the missing ingredient on that is the first novice or new syndicators that got in made a shit ton of money because of timing, right? They got lucky that rates went down. They got lucky that leverage went up. They got lucky that they could do 10% of the value add and relist it and make $1 gazillion. It was that anytime real estate investing, Brian, becomes easy and you've got all these people preaching it and then they're showing receipts and closing statements, they're like, I'm smarter than that guy. If he can do it, I can do it. And I think that's where all of this just went haywire. And it became about max leverage, overpaying. I know plenty of syndicators. I've been an accredited investor for well over a decade. And the people that I trust, they're like, not only have I not got a deal in the last 2 years, I haven't been in best and final in 2 years. And my underwriting hasn't been within 20% of the final purchase price in 2 years. It was stupid money, just easy money, bad lending, bad assumptions. The amount of stupidity the last year and a half to 2 years was very akin to the residential stupidity in 06. Variable rate debt, bad assumptions. I can always refi out. It is mind-boggling to see. And now the numbers are just much bigger. What do you think of all that?
Yeah, I don't disagree. What's it called? Recency bias. Whatever has happened in the most recent past is what you think will continue to happen for the future. And I think that's where we were at. Now, just to caveat that, the Fed was telegraphing that they were going to keep rates low for a much longer time. And so
2025,
I think a lot of,
right?
Yeah, a lot of people got caught off guard with that. And just the speed and pace of, but to your point, yes, everything was just over levered, way too hot. It seemed apparent from the outside that this was some sort of a bubble forming. And we weren't at the time interested, and we didn't do deals. Gosh, I'm not sure how long it's been now, close to 2 years, where we were just kind of watching and seeing exactly how this was going to play out. And that's kind of where we're at right now is, it's starting to play out. Right now it's really the kind of the worst of the deals that we're seeing the true distress. But I think over the next year, we'll likely see quite a bit more.
So let's flip to what's going on right now and kind of the reference to the Real Deal article. So there's a Real Deal article talking about a collection of very well-known syndicators. People can go find it. But at the end of the article, you were referenced specifically, as was Newvo Capital Partners. And really the story is you're going out and trying to, I'll call it, save syndications, perhaps even hopefully save some of the LP's money, because there's a lot of bad deals. So why don't you talk about what you're doing now at Newvo and what you saw, and we'll get into more of it there.
Sure. So like I said, we were on the sidelines, kind of pencils down for the last couple of years at my last company. And one of the sponsors that we were interested in investing in that had a good underwriting and conservative and knew what the heck he was doing was Stuart Keller, who's now the CEO of Newvo Capital. So within the last 6 months, we were talking about what's happening, what we see coming about, and realize that there's an opportunity to capitalize on this, but we weren't interested in being a vulture fund or somebody that just wipes out everyone. Obviously from vetting sponsors for the last few years, I've gotten to know quite a few of them, a lot, and a lot of them are talented individuals that did get caught off guard by the rates, and those properties can be saved. If it's truly just a financing situation and not an operational problem, there's something that you can do there. So as long as there's trust in the sponsor, there's nothing inherently wrong with a capital call or rescue capital or something like that. So what we're doing is working with the sponsors that have deals that have gotten into trouble because of financing and trying to figure out a way to save the deal. A lot of times we end up buying it outright and then just including the existing investors in our carry, not our new investors, but just what Newvo would make. We give a portion of that back to the seller and their investors, because it's really the investors, the limited partners that are getting hurt the worst here.
Yeah, that is something that I've been trying to scream for the past year. There's a lot of people, again, recency bias. They always talk about the last crash and the banks taking all these haircuts because on residential loans, it was 97 to 103% leverage.
Right.
Here, it's going to be the equity, right? The equity is, in many cases, frankly, going to zero. And I think some of these are already zero and the LPs don't know it yet, which is unfortunate. But what I saw in the article, and the reason I reached out to you is you are actively, and I think the article talked about you've actively already evaluated $500 million in deals.
That's
and
correct.
If I got the number right, you thought only 100 million could be saved.
Yeah.
That's pretty telling.
Yeah. So just to go into that a little bit, and that number is actually higher now. But,
Okay.
I think that quote was from a few weeks ago, so it's probably closer to 600 or 700 million now, but unfortunately not more.
Yeah. Oh no. Oh no.
So I guess, and just to clarify what I mean by being saved, we are not interested in investing in more than 100,000 of it, meaning it doesn't hit the return metrics that we require. Now the deal itself can probably carry on for a long time because you've got, if we want a 20 plus IRR, you've got a lot of wiggle room there. But the reality is, unless there's workouts with the banks, I do think a big portion of those will end up in foreclosure. There's varying maturity dates too, and that's a big factor. Some of these that we looked at mature in a few months. There's not a lot you can do. It's really the syndicators that have realized the problem and they have a maturity in 12 months and they're trying to do something about it now. So we're at the very beginning stages here where just, mainly the folks that bought in the beginning of 2021 with a 2-year rate cap or something like that are that's what we're seeing now. It really depends on when they bought and if they use floating rate debt. And that's really all I'm talking about with right now is assuming that they used a bridge loan, and not a permanent Fannie Freddie 5-year.
Oh yeah, 5-year, 7-year, whatever. Yeah, it's definitely the bridge. But that's, again, that became the only way you could buy stuff. That's the problem, right? Everybody was overpaying. You had to do it this way. It's just, it's very unhealthy.
There's roughly, based on what we've looked into from TREP and RCA and those guys, about, it depends on what metric you're looking at, but the most distressed, I would say, where we really think there's going to be trouble, it's about 130 billion, purchase in 2021, 2022 with bridge debt that matures in 2024 and 2025.
Yeah.
So
this is definitely, it's definitely a set of dominoes that are falling. They won't fall. Everybody wants it like immediate. We live in a very kind of microwave society. The process has started. There's plenty of pain, but would you say we're in the first, like if we used baseball analogy, 9 innings, would you say we're in the first inning of this?
First or second, depending on how you look at it, because, we were quite early, going back close to a year saying we can't buy anything. There's going to be a lot of distress. When is this going to happen? And so I guess as far as the things set in motion, we're past the first inning. But as far as seeing the distress, I'd say we're in the first inning here.
Yeah, and I think that's important, right? The pain is, I mean, I know lots of people out there, right, in the game, and the level of stress and out there is very high. And a lot of people were, to use your word, caught offside. They could be great operators, but the debt structure, it's going to get them unless they can do a workout. You used a phrase earlier that I think most of the audience maybe thinks they know, but probably don't. And that's really the difference between Newvo and a lot of the vulture funds that I see being spun up at other operators or other hedge fund or private equity. Can you help us understand and maybe put your little spin on what a vulture fund is versus what you're doing at Newvo and why there's that important difference?
Yeah, the vulture fund, that's not a fun name. Believe
No.
me, the guys that run those don't appreciate that term, but it's essentially, what a vulture does is after something has died, it comes and picks apart the carcass, and gets its value or nutrition from what's left over. And that's kind of where the name comes from. So the way they operate is there's no concern placed in the current operators or the investors or anyone involved in the deal for that matter. They're trying to
Right.
get the lowest basis possible for the highest return. And that's there's a time and place for those.
Sure.
It's a part of a healthy functioning economy, I suppose. But our take, there is a human aspect to this. And we believe that wholeheartedly. A lot of these LP investors are family and friends. Without a lot of money. These aren't professional investors. They saw a great deal, and believe me, we underwrote a ton of deals that the presentation is fantastic. It looks like it's coming from, a 200-year institutional investment firm. And so if you're a just, you have $100,000 in the bank and you want to be investing and you're hearing all of your friends talking about this great investment they did in real estate, it's very attractive. And so a lot of those people are tied up in these deals, and it's not like they have a huge savings account to tap into, which is also part of the problem. If the syndicator tries to issue a capital call or go back to their investors for more money to save the deal, because maybe the deal should be saved, it just needs new debt, there's no money there. So it's not necessarily that the deal itself is bad. A lot of these could be saved if they had enough capital to refinance. But the makeup of most of these deals that we've looked at, the investors just don't have the capital, even if they
Yeah.
wanted to.
Yeah. And I guess one thing I know, I think from our conversation and communication, we are talking about multifamily in this case. It's not like we're suddenly talking about office buildings, which everybody knows in trouble. We are talking about multifamily here, correct?
That's correct.
Yeah.
Strictly multifamily.
Yeah. I just wanted people to realize commercial wasn't this big thing. This is definitely a multifamily discussion.
Right.
I think a lot of people in the game have heard about that unfortunate deal in Houston, Texas, 3,200 units, essentially burned $100 million in 11 months of LP money. If we use that as a basis of an example of a bad deal, which I don't think is hard to call that a bad deal, is that a one-off unicorn, or are there others that kind of look and smell just as bad out there like that?
I don't think it's necessarily a one-off. We're probably going to see a few more headlines be made. That one was a special case where it was just very bad, though.
Yeah, very, very bad.
And that's kind of what I was alluding to earlier. Right now, what we're seeing are kind of the ones that are really in trouble. And a lot of times that comes down to more of an operational problem than just the financing. So in that case, yes, there's going to be more where there are a combination of operational challenges and inexperience as well as financing problems. But that one, I mean, boy, what a headline. I mean, that so many units to such a new player in the space.
Yeah, and literally lighting $100 million on fire in 11
Yeah.
months. That's hard to do. So again, where what I really hear you saying is what I think I see going on right now is lots of smart money, which I'll include Newvo Capital in that, is know there's a problem ahead. You guys are trying to get ahead of it by evaluating deals or properties / operators that can be saved. You're going to pass on a whole bunch. I don't know, 80% based on the math from earlier discussion. Those may end up just with the LPs wiped out, and vulture funds kind of picking at them, I guess.
Yeah, and I think I think going through an example would be really helpful here. So let's
Awesome.
just say in 2021, you bought you're a syndicator, you bought a property, 70% loan to value. That's not ultra
Not unheard
conservative,
of.
it's
Yeah.
not too aggressive. Well, and please let me know if I need to explain anything to the audience a little bit more, but your cap rate then, let's just say it was 4% when you bought. Now that cap rate is 6%. That is roughly, when you move up 200 basis points or 2% in a cap rate, going from 4 to 6, you lose about 33% of the value, roughly a third of the value. So in that very simple example, you bought at 70% loan to value, you just lost 30% value. Your loan to value, if you mark to market, is now 100%, meaning there
Yep.
is zero equity left in the deal. That's not unusual.
No,
We're seeing
100%.
that a lot. And that's where the creative structuring kind of comes into play. How do you return some capital to investors when there is none left in the deal? There's no equity left. Yeah, to be very clear, the equity has been wiped out in a lot of cases.
Yeah, and I know that's hard to hear, but again, 4% cap rates on B class properties wasn't not normal, and I would
No.
argue that 6% is far more likely. So if we're in a world where 6% is going to be more common, or heaven forbid, move to 7 with what's going on with rates in the economy, it could take a while to work out some of these. I think best case for LPs is they're going to have to hold for 10 or 15 years, right? That's going to be, it's better than losing everything, I guess.
Yeah, if you're able to.
Yeah,
And
of course.
that's where the loan maturities come into play. A lot of these deals, it's just not a good time to sell, so they'll hold on. It will have the default effect of lowering the return. If you hold it for longer, your IRR will go down. But you're not in trouble. You didn't lose the money. You don't have to realize a loss. And that's where the financing really comes into play. If you have a fixed rate debt, or if you can refinance one way or the other, you're going to be okay. We're not calling for the end of the world in multifamily. People still need a place to live.
Yep.
This is really about the decision that was made on financing a couple of years ago. And those are the ones that, without significant capital infusion or help, they just can't be saved. You can't extend the runway because you need the capital now to extend it.
Yeah.
So yeah, that's the bulk of the problem that we're seeing right now, is just there is no time, and you literally have to buy the time.
Yeah.
And where do you get that capital from?
Yeah. I mean, the other thing that banks could go back to do, and I think they're at least on the office sector, they're trying to do this. I do not know if they'll do this in multifamily, is the classic extend and pretend, right? Let's give the operator a year. I'm going to guess that's going to boil down to who the operator is, because I suspect coming out of this, let's fast forward 2 years. Let's assume we've got a cleansing. The pain has been felt. I suspect, like it always happens, some of the banks and lenders will quote unquote pick winners and losers. Like, hey, you're a good operator, you have a track record, you just got by, once in a lifetime interest rate move. We'll help you work through this. And then they're going to look at some other operator who's got one building, no track record, LPs can't kick in more money. You're like, well, you're out. I'm going to take your asset and give it to someone else. That could be an outcome.
I agree with what you said there. That's definitely a possible outcome, and we're seeing it a little bit right now. Where if you were a brand new operator, you're in trouble. You've already got that working against you. The current lender, now I'm not a lender, but from their perspective, my understanding of what they're looking at is, how likely are we to get our money back?
Exactly.
If we do some sort of workout, and that's the challenge for the syndicator or operator, is that you have to convince the lender that if you do this, this, and this for us, you're going to get your money back. Because that's really what they care about. And if the lender is able to get their money back quicker, or are more confident they can get their money back by foreclosing and selling it to someone else, they will. They don't want to do that. They don't like doing that. It's not how they operate. And so that's kind of a last resort for them as well. But if they don't have confidence in the operator, they're much less likely to do any kind of workout, extension, that sort of thing.
Yep.
And it is, as you mentioned, it's more common in office space to get those extensions right now. That's a whole nother discussion. I think it's because
office is simply not retrading. It's not trading.
Yeah. If they had to realize those losses right now and didn't extend it, we'd have a much bigger problem in our hands. So
amen to that. Well, do me a favor. I know we're running out of time. Where can people check out Newvo Capital Partners? And are you frequently quoted in Real Deal? Are you someone who's, articles? Do you write articles?
I do my own research for Newvo Capital Partners. That's part of my role as the chief analytics officer. So we do publish a newsletter. In fact, the best thing to do is people can check out Newvo Capital Partners on LinkedIn. We've got our page there. From there, you can subscribe to our newsletter and see the research that we're doing. That's a weekly newsletter that goes out with, we dive each week into a different topic and kind of show correlations in the market, talk about treasuries and what it means for multifamily, that sort of thing. So would love anyone that's interested to check that out.
Do me a favor, folks. You heard them. LinkedIn, Newvo Capital Partners. Go sign up for that weekly newsletter. I'll be doing that later today. Brian, thank you so much.
Thank you very much, Michael. I appreciate it.
All right, you got it.